Look at the continued reliance on the bank term funding program.
Yeah.
I think we are at 97 billion now. So this continued reliance means the tension is there, and the front end.
All right. Honestly, this constant blah, blah, blah about the banking crisis and liquidity and the reverse repos, it's all such crap. Like, give me some real, like, clickbait, please. Like, give me something good to talk about. Not this crap. It's such garbage. People are like, oh, but Kevin, this week the Treasury's gonna have to sell a bunch of bonds, and the banks are gonna have to take money out of reverse repos and buy it. Okay? Who cares? They got plenty of money to do it with. $2.1 trillion sitting around to go buy stuff with. $2.1 trillion in cash that banks have access to right now. These are massive institutions who use the reverse repo facility. People are worried about a lack of liquidity. What do you call this sack of cash? I don't know. The Bears they have to have a bearish take. That's what it is. You know what? This is the perfect time to give you Morgan Stanley's bear piece. You ready for the bear piece? I'll give you Morgan Stanley's bear piece. And in this bear piece, you're going to find out exactly how much Morgan Stanley thinks the market is actually going to fall by the end of the year. Brace for it, okay? You remember the days of, like, you know, the headlines like stock market to fall 50%, stock market to collapse 90%. Just wait for Morgan Stanley's updated bear thesis on just how bad things are going to get. All right, let's start with this piece. It's by Andrew Sheets. It's one heck of a last name. Anyway, our mid-year outlook, soft landing, hard choices. U.S. unemployment is the lowest since 68. Core inflation is higher than 83, while U.S. T-bills yield the most since Jan of '01. In other words, things is weird right now. We see global GDP slowing to 2.9% this year. So this is all of Morgan Stanley. They see GDP slowing to 2.9% this year. Notice that's actually a positive number. They actually see the risk skewed to the downside, but their base case is actually now a soft landing. One of the big bears of Morgan Stanley is actually talking about a soft landing now. But wait a minute, I thought this was a bear piece. It is, because they actually think the S&P 500 is going down from where it is now. Buckle up for how bad this L is going to be. Now, they do think that Europe and the United States will avoid a recession. They think that resulting growth in 2024 and for the rest of 2023 will end up being subpar, leading to basically an L of a recovery, which is basically no recovery. It's kind of like stocks go down and then they just trade sideways. That's in contrast with what a Nike swoosh would kind of look like, which would be something like fall rapidly down, recover, and then in the longer term, you somewhat just keep recovering, right? My thesis is obviously the Nike swoosh. I do think it'll be volatile, but the last couple weeks here since the AI craze, it's been just like straight up and less volatility. But volatility will come back to some extent. Tighter policy is a key driver of this subdued backdrop. Core inflation remains too high. And in our view, it's not necessarily about the Federal Reserve raising rates in the near term, but rather keeping rates extended for a period as inflation moderates. Now, this is actually, I wrote yes next to this because I've been arguing for probably months now, but certainly weeks, that I don't really care where the Federal Reserve stops. What I actually care about is when is the Federal Reserve going to cut? That's the part that matters to me, because my thesis is, hey, rather than send these confusing signals to the market where you basically pause in June and then hike in July, so you get an extra 25 BP in, why don't you just delay your first 25 BP cut by another month rather than send such confusing signals? So in other words, higher, or these levels for longer. So these levels for longer. Now, they do talk about that if the Fed does this, they would actually be raising the real policy rate, and that's true. They would technically be raising rates if rates are stable at 5% inflation expectations fall, then real rates would rise just by the formula of calculating real rates, which incorporates future inflation expectations. In English, Morgan Stanley's like, oh, they'll keep them high just to keep fighting inflation down. I actually think they'll start cutting, but so they can maintain a real policy rate rather than raise. But ignore that part for a moment. That part does not so much matter. That's more of opinion. What we care about is how much do the bears think the market's going to fall? Well, that comes up here on the next page. So they do talk about China's recovery reaccelerating. They think that potentially the market for China is seeing a bottom right now. But here you go. Many market risks appear front-loaded. Oh, this is interesting. The weakest growth is more likely to occur in the near term rather than in the long term. So think about all these different risks they're talking about here. The weakest growth is coming up now. The highest inflation going forward would be now. The tightest policy with the banking crisis and Fed rates, now. The largest shift in the Fed's or central bank balance sheet, Fed balance sheet, now. In other words, they say it's crunch time now. Now I wrote next to this, yup, gets clear after. Well, that's because I have this belief in the Nike swoosh that, quite frankly, once we get through some of these near-term catalysts, inflation, is it going to be sticky or not? And you know, the banking crisis, the subprime autos disaster, the commercial real estate disaster. We've already got through the debt ceiling. Once we get through some of these near-term disasters, as I wrote here, I believe it gets pretty clear afterwards. In other words, we're really out of negative catalysts. If inflation goes away and the commercial real estate crisis goes away because maybe rates start falling or whatever, or maybe offices default, big deal, then you really potentially don't have many catalysts left for negativity. It's hard, in my opinion, to actually validate being bearish right now. Consider for a moment that even in the commercial real estate market, a lot of people are like, oh, but Kevin, you know, Charlie Munger says there are a lot of bad loans and commercial real estate is really at risk of dangers. Well, one of the things that I want to actually highlight, that's what I wanted to go to, is look at this. I pasted this from the Financial Times. So the Financial Times wrote that PacWest last month sold $2.6 billion of construction loans at a loss. Now that sounds really bad, right? A bank selling $2.6 billion of loans at a loss. Sounds terrible, right? But what's remarkable is look at this right here. They sold those loans for 92 cents on the dollar. And as soon as they sold those loans for 92 cents on the dollar, which is only a measly 8% haircut, their stock moved up 20%, which the Financial Times argues might lead more banks to want to make these sort of deals. But if there's an appetite to pick up these loans for 92 cents on the dollar, that's barely a discount. So I'm trying hard to find a bear case here, right? So we're looking at this bear argument, and the bear argument, according to Morgan Stanley, is, well, all the leftover catalysts are now. Yeah, because after that, there aren't that many leftover catalysts that are that negative. And I understand the yield curve is still inverted, and that should be signaling a recession at some point in the future. Fine, whatever. There was going to be a recession in 2019 as well, and then COVID made that happen. Okay, maybe there'll be another disaster like that, whatever. So anyway, they talk about muted returns going forward and how they believe that defensives will actually outperform. Now, we'll talk about that, but first, let's talk about how much they think the market is going to crash. Right after, I remind you to check out the programs on Building Your Wealth link down below, especially the How to Make More Money and Get SH9T Done Faster course featuring artificial intelligence. Those lectures drop at 6 p.m. tomorrow, June 6th at 6 p.m. We'll be dropping all those lectures. They'll be really, really cool. I've been working on those for quite a while with the team, and I think everybody will really enjoy those. So check those out, link down below. At least click the link, go to meetkevin.com down below, and see what kind of courses we got there, because there's some really good ones. And I really don't believe, or I should say rather, I really do believe that that nobody really continues to add as much value to courses as I do. So I'm very excited about that. Anyway, here's what Bloomberg reported. So Bloomberg got the full research piece on this. I only got the first 2 pages. And apparently in the full research piece, Bloomberg reports that Morgan Stanley thinks that there's going to be a 16% profit drop in S&P 500 companies. Now, I have a thesis about that. I'm going to talk about that. But Morgan Stanley sees the market at 3,900 at the end of the year. Do you know how much of a miserable drop 3,900 is from where we are now? Do you remember when the bears are like, we're going down 50%? You remember this, right? Bears say we're going down 50%. You know how much the bears think the market is going down today? Is it 50%? Nope. Could I interest you in negative 40%? No. How about negative 30? Nope. How about negative 20? 15? No. 10? No. The bears literally now are quite frankly forecasting that by the end of the year, the S&P 500 is going to go down a very, very dramatic and scary 9%. Come on, man. What is this? Like, Morgan Stanley, you know what y'all have just done?
Lost the lead.
This is ridiculous. That's the most bearish you got? In fact, Bloomberg, I wrote this quote down. Bloomberg literally said that a 16% profit drop, which is different from the 9% SPX target, a 16% profit drop for the SPY, SPX, same thing basically, is, quote, one of the most bearish predictions of economists on the market right now. It's just stupid. Quote, we think the downside risk to earnings is now. While deteriorating liquidity backdrop is likely to put downward pressure on equity valuations over the next 3 months, we also see earnings per share disappointment ahead as revenue growth slows and margins further contract. These people are so bearish and they're so negative all the freaking time, and yet their bear thesis gives them a total of a negative 9% from now return for the S&P 500? Bro, the S&P 500 has already returned 12% this year. So even if that happens, the S&P would be up 3% by the end of the year. That's wild. Okay, I know there'd be a little bit of a math adjustment there. Now, they talk about defensives. So what are defensives generally? Generally, defensives are going to be your healthcare, consumer staples, and cash. I can get behind cash to some extent, especially after this like AI hype rally. I think it makes sense to have a little bit of cash on the side again, just after some things have really, gotten a little quickly here, and potentially some things are getting a little detached from fundies. But aside from cash, do I really want to move my money into staples right now? No, I've kind of been bagging on staples and the likelihood of them missing earnings for a while, and now you're starting to see it. Home Depot, Lowe's, Costco, they're not having great results. Maybe a place to actually look could end up being retail, because when we were talking about this with course members on Friday, retail actually has really sold off when you look at the stock market. But retail is a discretionary. That's not a defensive. That's the opposite of a defensive. Retail is a cyclical, which is, again, the opposite of a defensive. Defensives would be, again, like real estate, utility REITs, cash, healthcare, staples. And then they do think that commodities will end up continuing to lag. So I find it actually wildly encouraging that you could have a company so bearish, yet their bearish forecast is a whole negative 9%. I don't know, Andrew. Maybe y'all need to be a little bit more bearish. Maybe y'all can get out there and find me a little bit more of a bear thesis. Now, look, I get it. There are a lot of people that are like, but Kevin, we're going to see rates go up higher. Okay, all right. And the market is pricing in too many rate cuts. Okay, let's take a look at exactly what the Fed is pricing in, or rather markets are pricing in right now. So what we could do is let's do a couple things here. Let's press this button to begin with. Here you go. Right now there's an 82.7% probability of a pause in June. And then for July, we're actually at a 56.2% chance of a rate bump. Now, I'm not the biggest believer that any of that is a very big deal for the market. I think the market is going to be a little bit more interested in fundies than that. And those are not the scariest fundamentals by any means. So, I don't know. I really believe the bear argument here is relatively weak. I know people, again, I see these comments all over the place about, I see the Twitter threads, I see all this nonsense about the student loan repayment stuff. I don't see the student loan repayment stuff as being a big catalyst. It's such a weak catalyst that even the Morgan Stanley bears aren't talking about it. And that's, again, in part because expectations are the student loan pause would really only affect consumer GDP by maybe 0.1%. That's nothing to care about here. I mean, really, it's like, who cares? I mean, sure, we could try to flip around and see if we can get some kind of bear case on these student loan repayments. I'm trying to see if I could find one here really quick. Yeah, here's the J.P. Morgan case on student loans. Ready for this? Like, let me actually show, rather than these trash Twitter threads. I shouldn't be so negative, okay? Some Twitter threads are good, but oh my gosh, the amount of Twitter threads that are just devoid of valid context just makes me angry. But it actually, I think, gives me the opportunity to speak, hopefully in an educated manner here. I try my best. I really do. We really try our best every single day to bring great perspective here. But let's look at some reality, okay? Here of some like real estimates rather than just people hypothecating on Twitter. Here's at least a financial estimate. And I'm not suggesting these economists know what they're talking about. I mean, just to be clear, look at this little note here. I wrote, as I was reading about this, I saw a headline that UBS is still forecasting. It wasn't actually a headline. I was listening to Bloomberg, and this was a senior economist at UBS, and he's like, "Yep, recession Q3." And the lady's looking at him like, "Really? You realize Q3 is like a month away, and there's no indication we're going into recession. You recognize that, right? Remember, April, May, June is Q2. We are 3 weeks away from Q3. UBS says the recession is 3 weeks away. That's it. There's the title of the video. Recession 3 weeks away. It's complete garbage. Nonsense. There is no recession 3 weeks away. But anyway, let's go to the JPM piece here on the student loan. Student loans, U.S. prospects. Here it is. This was at least an educated argument, so I can get behind this. So student loan debt repayments are going to recur 60 days after June 30th. And so that means payments are going to resume at the end of August. That is within Q3, in fairness. The Bureau of Economic Analysis believes that this could have an impact of around 0.2 percentage points on consumer savings. And then here you have potentially a lowering of GDP by around 0.1%. However, they did give a slight warning about the student loans, and I'll give them this. They did suggest that most of the impact could end up being front-loaded. So what this really means is that you might almost hit the market with a little bit of a shock that you have to go back to making those student loan payments. And so you could see a sudden pause in spending, so to speak, versus the reality of this being basically nothing. I mean, if GDP is, what's the Atlanta Fed now? Let's see. Atlanta Fed now, real GDP forecast. It should be like 2.6% or something like that. GDP now forecast, 2%. Oh, that's actually ticked down a little bit. So you've got a tick down in the GDP forecast now to, 2%. I'll show you this right here. Here's the Atlanta Fed GDP estimate, 2% for June 1. That is actually a tick down. But again, consider 0.1%. Are we really even going to notice that in any direction? Unlikely. Is it possible, again, that if it's front-loaded, maybe it's more of like a 0.4% impact? Yeah, that'd be a little bit more noticeable, but at least we do still have some room here, which is nice. So yeah, of course, there's always a risk with everything, but I suppose my belief is that this is just another sort of bear thesis that's being thrown forward about like, oh, that's it, here it comes. And then you also have to wonder, like, what kind of consumer does this affect more? And, well, here you go. The beneficiaries of this student loan forbearance program are likely to be young people who have a higher marginal propensity to consume rather than older households. In other words, they spend all their money because they don't invest. About 20% of the outstanding student loan balance is for those between 18 to 29 years old. This makes student loans the largest form of debt for this group compared to other forms in other households like credit cards, auto loans, in other words. Hence, we think assuming a relatively large multiplier with a more immediate impact after the forbearance end date is reasonable, especially amongst wherever you think those 18 to 29-year-olds are spending. So where do we think 18 to 29-year-olds are spending? Well, they're probably, not many of them are probably spending money on Teslas. Probably more of that money, I would guess, would be going into some form of either travel, entertainment, hotels, restaurants. I doubt many of them are buying Enphase products, NVIDIA products, Tesla products, maybe Apple, maybe. Who knows, right? So it's something to think about, but again, it'll probably smooth out to being something more like a nothing burger. So I'm not very negative on the student loan issue. Now, if you look at the world interest rate probability, I enjoy looking at this. This gives us another look at sort of the Fed, and I love the forecasts here because they give us a little bit of an idea of, okay, well, like, how bearish is the Fed right now? And when it comes to, or the market on behalf of the Fed, I should say, this is the world interest rate probability chart right now. It looks like that peak is being priced in right now for July, and you price in the first potential cut as early as September, but certainly you're pricing in cuts to back down to the 5% range by December. That could all be one cut, by the way, and then you're looking at your second to third cut over here in January. So, and that does not necessarily mean the economy is going into a recession. This just simply means the Fed's going to follow real rates down as inflation expectations rotate down. So, I guess the long and short of this piece is Morgan Stanley and UBS are bears. Their bear arguments are relatively weak. Yeah, we could try to stretch the explanation that maybe you've got this student loan segment that's going to hurt some people in August and September. Well, it'd be the end of August, so more realistically September, October. Yeah, that is when people are forecasting a recession. Is that alone going to be what does it? No, but we'll see. Personally, I think it's just more bearish news and nonsense, and I don't really think the bears have a lot going for them right now. But yeah, I guess nobody can fault me for being clear about my opinions. And hey, if some real bearish news comes out, I'll be the first to flip-flop because nobody knows how to flip-flop better than Meet Kevin. But that's a good thing. I think that's when the data changes, we change our opinion. Now, I want you to know this. When it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced by